Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It's lecture time, and this week's lecture is trade the damn chart. That's it. Stop. Just stop. Stop with the Jim Cramer. Stop with the Maria Bartiromo. Stop with listening to Tim Cook or the Bitcoin guru or this or that. None of it matters. I know you all think you have an edge by listening to what Jeff Bezos says or what Motley Fool tells you or finance.yahoo or CNN or MSNBC or Fox Business, blah, blah, blah. It's bullshit garbage. They're entertainers. You think Tim Cook's going to come out and tell you not to buy Apple? Apple's in trouble? No, it's not going to happen like that. I know you think that all these indicators and spaghetti charts you're using are helpful. They are not helpful. Stop. Just stop. Okay? Focus on price and volume. We're going to talk about that today and how important this is. Trust me, if all those indicators really worked as well as you think they do and as well as you say they do, you wouldn't be listening to this video. You wouldn't be in your mom's basement in your pajamas. You would be having coffee, tea, and champagne, I suppose, with Jeff Bezos and Bill Gates and Mark Zuckerberg and all the rest of them. But you're not. So get rid of that crap and that garbage and pay attention to this lecture because we're going to dig deep into the core of technicals. Okay, we're going to dig deep into the fundamental of technicals, if that makes sense. Okay, it's a very powerful lecture. It's a very good lecture. And I'm basically going to teach you exactly what I use to trade the markets every day. Exactly. Not fluff like everyone else out there. You know what they're giving you? They're giving you a video and like, oh, look at me. I made $10,000 on this trade. And then they don't teach you jack shit. They're like, just come follow me. You can't copy your way to success. They're going to tell you can, but you can't. All right, they're going to give you 5 minutes of quality and 30 minutes of sales. This lecture is pure gold. All of it, all 55 minutes of it or whatever it is how to be the best trader you can possibly be. All right, if you like the videos, click that link below, hammer that subscribe button. I'm Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is trade the damn chart. Yes, a strong comment to be sure, but it's a truthful one, okay? There are way too many distractions for most traders, and your focal point is on the wrong stuff a lot of the time, especially new traders. I mean, it's astonishing the sheer amount and level of bullshit that I hear out there. Oh, my Uber driver said this. Oh, my cab driver said that. Oh, my aunt's uncle, second brother's cousin's third sister said that she heard from the CEO of XYZ that the CEO of ZYX is doing this. Just stop. Just stop. You have red and green candlesticks, right? And those candlesticks are the flow of money. Right? So think about it like this. Every time that somebody places a trade, that trade forms a tick, that tick forms a bar, that bar forms a chart, those charts form trends, those trends form patterns, and those patterns are what we freaking trade. That's it. Not what Jim Cramer says on the television, not what Maria Bartiromo wears this week, and nothing else in between. Not even what Tim Cook of Apple says. Their job is to get you to think good things about their company. That's not beneficial for us. Enron was great until it wasn't. Yes, that's an extreme example, but I think you understand, okay? I think you understand what I'm talking about. No, actually, it's completely on the fly, Brian. This is truth. I just think of this shit as I go. It's true. My point I'm making is push aside, eliminate the distractions. They're not helping you. I know you think reading the news today, oh my gosh, I saw that, XYZ company's coming out with a new drug, a new technology, an oil spill, blah, 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 blah. I'm going to buy this. I'm going to short that. It's like, wait a second, hold on. And this just happened recently. So wait, let me get this right. So Meta crushed earnings and gapped down. Amazon crushed earnings and gapped down, all right, initially. And then Tesla kind of shit the bed and they gap up. There's no rhyme or reason to it. Don't act like you know. Because if you knew, you wouldn't be listening to me right now. And you know that's the damn truth. If you knew, you wouldn't be sitting here. You'd be on your 300 or 400 foot yacht serving margaritas and champagne to Jeff Bezos and Bill Gates. All right? But you're not. So you don't know. And don't act like you do, because you don't. All right? And that's just a fact of it. Push your ego aside. All right? All these indicators, they're not helping you. All these news reports, they're not helping you. You might think they are. But for all that, and I said this to you guys earlier today, for everything I just said, the proof is in the pudding. You can think what you want to think, but the proof is in the pudding. And the pudding is the average person underperforms the market by 4% per year. The average person underperforms the market by 4% a year, and well over 90% of hedge funds underperform the market also. Does it change your perspective at all? Oh, wait, I forgot. You're different. You're special. You're different. You know better. That's why you're in your pajamas in your mom's basement, because you know better. Get the F out of here. You don't know better. The only thing you know is your ego is strong. That's it. It's the only thing you've learned. So, now that I'm off my mini tirade, I hope I've gotten your attention, because I wasn't joking about a single word I just said. Get your shit out of your ass, all right, and pay attention, all right? So, before we get into the lecture, let's talk about when will the insanity stop. Why? Because it kind of segues nicely into what we're going to talk about today. I have shown this one before, and to be honest with you, it's a painful one. It's a painful one because this person actually reached out for help and still did the same stupid shit they were doing before they reached out for help. Now, think about that for a second. They got smoked, lost a lot of money, reached out for help, and then decided that, wow, that advice was too helpful. I don't want to listen to such helpful advice. So let's take a look. Okay, becoming an investor, all right? This person reached out for me. Hey, Jared, I tried day trading for 3 months now, but I guess it doesn't suit me since I've lost over $100,000 already. I do accept the fault being a FOMO and over trading, okay? That's just the beginning of that, right? I said, if you can't control risk, then no, it's a terrible idea. How in the world did you lose $100,000 in 3 months? That's just straight up gambling. You need to have some level of control to be a successful trader, swing, core, or otherwise. If I were you, I would just take whatever money you have left and put it in a Vanguard 500 mutual fund or a total market fund and let it go. Don't touch it for 20 or 30 years. Okay? Jared, this, okay, and this was 12 days later. 12 days later. You can see it, Feb 17th, Feb 29th. Okay? This will be my last mail to you. I should have really listened to your advice and put the remainder of my money elsewhere, but I tried day trading again on Dow 30 with 200 to 1 leverage, and I lost it all. My net worth is zero now, and I feel suicidal. I've got 3 kids, and my wife doesn't know about it. Overthinking about the mistakes I did is killing me. Total loss now stands at $170,000, which is my whole life savings. I just wanted to recover what I lost and get away. But the market is really a shark, as you said. That's a real story from somebody. That's not fantasy land. This really happened to somebody. $170,000. And when they use the word my whole life savings, I'm assuming it took them quite a while to save that. 170 grand. Takes a long time to save that for most people. 3 kids and a wife. And that was what was going to help you retire someday. And your wife doesn't know about it. Sad. I've become another statistics and just wanted to hear some sort of advice in this situation from you, how I could cope with life as everything looks bleak to me. Well, I gave you that advice. Now, the only reason you'll listen now is because you don't have any money left and you don't have a choice but to listen. But I gave you the advice, which was very, very, very good advice. At least you still would have had 70 grand left. And had he done that, by the way, and I just want to be clear, just so you guys know, this was 2 years ago? 2 or 3? 2 years ago? Had this person put it in a total market fund, they would have doubled their money. Well, not doubled their money. They'd probably be up about 40%, 50%. They'd have over $100,000 left, you know? I do these every week, guys. Not so we can have a laugh at people. It's so that you can read this and get scared shitless. I mean, this should scare the bejeebies out of you. It should, because this is someone's life savings with a wife and 3 kids. And I don't know how old this person is, but with 3 kids, they're probably in their 30s, maybe older, I don't know. But now you got to start over. And now, as we've seen from professional wealth building strategies, it's going to take you a lot longer to get that money back. Okay? It's utter lunacy trading, Kirk. But here's the problem. It happens every week. I have a stockpile of when will the incentive. I mean, guys, hundreds of these things. Literally hundreds. So this isn't like an isolated incident. It happens all the time. So while you look at it as lunacy, which is good, because that means you probably won't do it, this is happening to somebody today. And it's probably happening because they think that trading is easy somehow. Oh, I had a buddy who bought some Bitcoin and now he's rich. I have a buddy who's a doctor and they did this and blah, 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 that. And they come up with these ridiculous excuses. And then the worst part is they leverage it out with options or Forex. This guy, 200 to 1 leverage. Damn. But I have another one for you. It's not really when with the insanity. It's just to get you guys to think more that people really do this stuff. Okay? You've seen this when I've showed this to you years ago. This person is down 15% of their account today. How the F can you lose 15% of your account in one day? It's called lack of money management. Minus 17.5% this week. This isn't like 17.5% on a trade. This is your account. This is your entire account. Imagine having like, I don't know, a $100,000 account losing 17 grand in 1 week. This person's down 94% this month. 94%. This person had a $25,000 account. Now they have a $1,500 account. This person's down 18% this week. So you guys wonder why Unmal and I are such sticklers, why we're so hardcore about money management. Because it's the only thing that will allow you to succeed in this business, because nobody, I don't care how smart you are, nobody, quote, gets this the first day or the first week or the first month or even really the first year. So if you think you're going to get it and don't use good money management, this is going to be you. You will be a statistic on here. Please don't. That's all I can say. I'm trying to help you. I'm trying to hammer this in. I'm not going to be around forever. I'm telling you the truth, guys. I'm going to just vanish like a fart in the wind one day, and you're going to be like, where did Jared go? And you'll never hear these lectures ever again about money management. Do you know why? Do you know why? Because I've been around doing this for a long time. I've been to a lot of other chat rooms and a lot of other educators. There are a handful, and I'm literally saying a handful, 3 to 5 that actually talk about money management. The rest of them YOLO it. They diamond hands it. Oh, I took a $346 account and I turned it into $1 million. Aha, how'd you do that? By just risking everything on every trade every day. Hey, it works for somebody. 1 in a million is like winning the lottery. How many times have you won the lottery? Probably never. My point is money management is just not something people talk about. It's just not. And I am here to tell you, if you don't get serious about money management, you won't be around very long either. Guys, you remember the statistic I told you? I'm not going to say. I'm just going to use one. I'm going to use the percentage. You guys remember last week I said 4%. You guys remember that discussion, what that 4% was? I don't need to rehash it. 4%. The people who know what I'm talking about know what I'm talking about. The other ones, oh well. 4%. All right, now, let's dig in. Let's get our learn on, even though what I just taught you about money management is more important than anything anyone could ever teach you ever in this business. Indicators. There are lots of them. Lots and lots and lots of them. It's like Rain Man. There are lots and lots of them. When I first started trading, there really weren't that many indicators. I mean, there was some, 20 or 30, but now there are hundreds of indicators, okay? Hundreds of indicators out there. How do you know which one to use or which ones are good and which? I mean, people, they're like the Bitcoin cult. People swear by them, right? People swear Bitcoin is the real. You don't understand what you're talking about. It's blockchain. Okay. Indicators are the same thing. Somebody's like, oh, the death cross. Literally, there's an indicator called a death cross, okay? The death cross is the best indicator I've ever used. Someone else comes out and says, oh, no, that's garbage. You need to use QQE. QQE is the real deal. Someone else is like, nope, I'm going to use alligator. You think I'm kidding. These are real. I'm going to use alligator. And I'm just sitting here like, is this a new language you guys are creating? Are you just trying to rebadge the English language? What are you doing? I mean, there are hundreds. I don't even know the exact number, but there's at least 300 or 400 indicators out there, okay? And most of them, I don't say about all, but the vast majority of them, 95% of them, are based off of price and volume, right? Jordan knows this. So if they're based off of price and volume, maybe we should just look at price and volume. Jared, stop. Stop with this common sense talk. Enough. Blasphemy. Yes, blasphemy. Okay? So I am here to tell you, I am not totally against indicators. I have a moving average or two in my chart here or there. Some people use, the put-call ratio, the advanced decline line, the COM channel index. I get it. It's fine. Implied volatility, whatever. Okay? But I'm here to tell you, limit the number of indicators that you use. Because you get to a point, and you've seen this before, and I'm going to go backwards. You get to a point where you're like, the hell am I looking at? But people do this all the time. Look at stochastics. You got a 60, a 20, a 10, a 10, a high, low, close, simple moving. I mean, look at all this shit. Look at all these moving averages and lines on here. This is real. I pulled this off the internet. This is real. Okay? Apparently, this person believes that there's value in this. And maybe there is. I don't know. But I just don't trade that way. And I'm not saying that it's impossible to make money trading this way. I'm just simply saying, why make it more complicated than it actually needs to be? I am looking for the flow of money. And you guys know, for example, one of my big things is bottoming tails. I love to see bottoming tail shakeouts, pictures of money. I love it. We're going to talk about Tesla a little later today, okay? So when you think about all that, what are all of those lines and squigglies doing that a red and green candlestick can't do for you? Is it really giving you an edge? I don't believe so. So the reason I'm telling you this is you can use an indicator or two, but if you're a new trader, you're going to be more successful quicker by not using them. I know you're thinking the opposite. You're thinking, oh, if I just slap a good old MACD or Bollinger Band on there, I'll just be more successful quicker. No, the opposite. It's just one more layer of learning that you have to do. And I don't really think that it's very helpful. So, indicators are subjective, and they're usually a crutch for newer traders. They are subjective. Okay? The only thing that's real is price and volume. You've heard me say this, and I haven't had this discussion in a long time with you guys. The only thing that's real, like truly real, is price and volume. Because it represents something that actually happened. Oh my gosh, 100 shares were printed at $210. That actually happened. So then the indicator can be formed after the price and volume happens. But the indicator can't be formed before that. And I know what some people are thinking. But Jared, that's what the indicator does. It takes past price action to predict the future. That's what the candlesticks do, dumbass. That's exactly what red and green candlesticks do. But the only difference is I'm going right to the source. instead of some squiggly line that some person made up. And if it was so damn good, why are there 500 of them? And why aren't those 500 people at the same party that Jeff Bezos and Bill Gates are at? I don't know. So, again, to repeat myself, you can use one or two, maybe three, but don't get in the habit of the spaghetti chart problem, okay? Price, by definition, has to lead any indicator. Without price, nothing happens. Let's say it again. Think objectively. Without price, there is nothing. Imagine if you woke up tomorrow and Microsoft was 00000. There's nothing you can do. There's nothing there. So price has to happen first. Go to the core of the issue. Okay? Indicators can't happen without price first happening. Okay? And if there's no volume, then price is irrelevant because there's nobody willing to buy it for, quote, that price. So they go hand in hand. You can't have one without the other. You can't buy something that has no price. Right? If somebody says, hey, I like those jeans, well, they're not for sale. Well, then you can't buy them. They're not for sale. There's no price on them. Right? And on the flip side, if somebody says, hey, they're $127, and you're like, well, nobody in the room is willing to buy them. Well, there's no volume then. You have to have both, right? You have to have both. So again, I'm not against indicators. I'm against too many indicators, okay? Guys, other than money management, I am literally explaining trading, 667 pages of professional trading strategies, like literally on this slide, other than money management and trade management, okay? Multiple concepts converging in an area is what you're after as a trader. Discernible patterns, bottoming tails and topping tails, wide range bars and narrow range bars, support and resistance, retracement levels, change of color bars, balance of power shifting, increased volume, ending versus igniting, stock showing good liquidity, relative strength and weakness. Is there relative strength and weakness? There it is. Stock showing relative strength and weakness, not up more than 3 bars, within its average trading range, market time. Holy shit. That's everything. It's every bullet point out of the damn book. It's not every, but you get my point. Entire chapters are dedicated to these bullet points. Entire chapters. After getting all of those things, then you can look to see if there is an indicator confirming what you're already seeing. Guys, please write this sentence down. Copy and paste it, screenshot it, whatever. After getting all of those things, then you can look to see if there is an indicator confirming what you are already seeing. You don't put the indicator first and hope the rest of the things are behind it. You put these things first and hope there's an indicator confirming it. It's not the other way around, right? It's not the other way around. Emotion comes before thought. Thought doesn't come before emotion, okay? Now, these bullet points are gold, okay? Read them again. And these are the things that you should be seeing on almost every trade you take. Remember what we talk about in your trading plan? You need a pre-trade checklist, check. These are kind of the must-have things in your pre-trade checklist, right? In no particular order. For me, for example, I love relative strength and bottoming tails. Those are the two things that I hang my hat on all the time. I would take, and I know I should never say this, but I'm going to say it, I would take relative strength and a bottoming tail over a discernible pattern. I know I should never have just said that. Now, obviously, we'd like to have a relative strength or weakness stock with a bottoming tail with a discernible pattern. That would be really, really nice, plus a lot of these other things. But these are the things you're after to be a great trader, okay? Less is more, guys. Why so many indicators? Let's be honest about it. You're searching for the Holy Grail. That's it. I just summed it up. I summed this whole slide up. The reason indicators exist for most traders is they're searching for the Holy Grail. They'll see a successful trader and the guy's like, oh yeah, I use MACD crossover. Oh, well then I need to. You'll see a successful trader and they're like, oh, I use QQE with alligator. You mean to say that with a straight face. I use a death cross alligator QQE indicator. Good for you. The point is, people are looking for holy grails. The holy grail are red and green. And they're candlesticks. They're red and green and they're candlesticks. Okay, I didn't name my daughter Alligator. I actually know a person, by the way, Brian, that he has 4 kids. Okay, not 5. He has 4 kids. I swear on my life this is true. He named 4 of his kids after the 92 Bulls. 4 of his kids are named after, he doesn't have 5. It's crazy. Some people actually do that insane stuff. Anyway, less is more. New traders lack confidence, they lack knowledge, and they like to blindly follow other people. Gurus, whoops, sorry, wrong slide there, whoops. Gurus, whatever, okay? That's not the answer to your problems. They're always looking for an edge, the holy grail. I get it. We all are in a way. And when you're new, you just don't know the difference. But you have no idea what you're doing when you're new. Right? You're confused, you're lost, you're unsure, you're unclear, you're perplexed, you're disordered, you're bewildered. You're just naive. Okay? So please, when it comes to indicators, don't do this. Right? Come on, guys. Don't do this. It's just so unnecessary. All right? You've seen this. It's in PTS. It's right out of the book. Why isn't there a COM channel index? Where's the alligator death cross QQE Bollinger Band Fibonacci retracement with 27 different moving averages on it? Where is that? How could I possibly figure out what this chart might do next without all of those indicators? That's crazy. This is just red and green candlesticks, right? Buyers and sellers with volume and a simple indicator, which in this case is a simple moving average. Okay? Topping tail, doji bar after a gazillion bars up, far from the moving average, far from support, extended, dailies extended also. That's it. That's it. 66.50 is the entry, 67 is the stop loss. There's your entry, there's your stop, and your target is 50% retracement. Moving average, support, right out of the book. Higher time frame bias is short because it's climactic. Our job is to find a lower time frame entry. Why don't I have all these things on this chart? Like what's wrong with me? Because they're just unnecessary. There's just no need for it. There's no reason to have it. So why do people? It goes back to what I just said. They lack confidence. They really believe. Let's be fair. I was there too, guys. I mean, when I first started trading, I had a COM channel index and stochastics on my chart. That's a true story with moving averages. Now I don't even like to put moving averages on there. Because once you find out what's really actually important, which is candlesticks, you don't need anything else. But people still do it. And for me, when I see somebody that has a spaghetti chart, to me, it's a lack of confidence. Now, there might be some people out there that are highly successful that have spaghetti charts. I just haven't met too many of them. Right? Here's another example. Take the daily, the higher time frame. Yes, it's a little far from the moving average, but it's gapping up and it has room back up to 56 bucks. The higher time frame bias is long. It's in an uptrend. The lower time frame, our job is to find a pattern. Here is a bottoming tail with a buy setup. Okay? Here's a bottoming tail with a buy setup. And this thing ends up going, $2 or $3. There's the call. There is the profit. All right? I'm going to go through some of these quick because I have a lot of slides to go through. All right? Multiple time frames, clean chart. All you see are moving averages on the daily. They're not even on the lower time frame. All right? This stock, now I know you're looking at going, it's red, but it's a daily buy setup, right? At the time, we had a daily buy setup with multiple bottoming tails. I've done whole lectures on bottoming tails, entire lectures on bottoming tails, okay? Little bottoming tail bounce, little shakeout bar, you're getting in above all this. This area has now been tested. If you'll take a look down here at 740, there's also a little bit of support down here as well. But not only once did it bounce, we're not buying it on the first bounce because that could just be an anomaly. But the second bounce that leaves this monster bottoming tail, and there's a little volume spike down there, you're buying this bad boy right above this little consolidation. At 769, your stop's going under the bottoming tails and rip. That's it. Now, some people go, wow, 40-cent gain doesn't seem like much. It's only a 20-cent stop. You know, make $2,600 on it and you're done. Because of the second bottoming tail, right? It's a picture of money is what it is. It's a confirmation of strength. Buyers tested the low and they beat the sellers. The seller's like, no, we're going to go lower. And the buyer said, no, we're not. We're going to go higher. That's your confirmation. We're going to keep doing this for a long time. Okay? What do we have? An uptrending daily chart, an uptrending stock. It's gapping above the high. I think it's like $40, give or take, whatever that is. Okay? So what do you get? Oh, this is wrong. I just realized. No, it's not. Never mind. My bad. I was combining both of these. It's correct. All right? So what do you get? A very, very mediocre 3-bar play on the 1-minute chart. Very mediocre, but strong because the daily's in an uptrend, gapping over a red bar. Okay? And you're getting in at $40, all right, which is, I think, just under $40 was the entry, I think. Yep, it was. Just under $40 was the entry. Okay? And then your stop's down here. Boom. All right? Now, I'm going to continue to repeat myself. I do not have a problem with people using a couple indicators. People use VWAP. People use moving averages. That's fine. I have a problem when people put them all over every area of their chart. It's like graffiti to me. That's the way I look at it. It's graffiti. And they're unnecessary. As this slide said, pick 1 or 2 or 3 and be done with it. All right? This was a trade on Meta. Multiple things that made this trade. Market mega gap down. Mega gap downs usually bounce. Meta large gap down usually bounces. Meta huge bottoming tail on volume usually bounces. Okay? Before the market ever opened, Q's down $7.42. If we drop early, look for a $2 to $3 bounce. Right? Look for a bounce, basically. If we drop early, 2 to 3, look for a bounce. If you are a long trader, today could be a huge bounce if the market sells off quickly. I'm reiterating what I said 2 minutes earlier. Faves, Meta over 423. Why am I showing you all of this? I'm showing you all this so you guys don't think that this is just random dumb luck bullshit. This is before the market ever opened, before I even knew what Meta was actually going to do. I'm telling you what you should be looking for given the current environment we are in. And this wasn't that long ago. This was like less than a week ago. I'm telling you the Q's gap down massive. How many $10 down days do we see in the market? Not many. 1 or 2 or 3 a year? So if we drop early, go down $7, $8, $9, we're going to bounce. Therefore, take the most extended stock you see, go long. Take the stock with the most relative strength, go long. Well, for me, that was Meta. Mega gap down on what were very good earnings, right? $4.90 down to $4.20. It was like a $70, $80 gap. Bottoming tail, market. It was on the long watch from 6:19 in the morning. It was on the favorites list at 6:25, or it's really 9:25, right? 9:25. And then these 2 comments were made. That's it. It's not gambling. It's not luck. And if it is luck, then I'm just a very, very lucky person. Okay? This is not rocket science. Now, obviously, this is old. NVIDIA is way more than this now, okay? But this is all I do in the morning. There's no indicator on this chart. Do you see an indicator on this 60-minute chart? No. This is a list of dollar gainers, and I'm looking at stocks with big volume, so I'll look at Amazon, Tesla, and NVIDIA. I'll click on all the one PRNB, right? I'll look on OSTK, which we haven't seen in a while, by the way. PDD. I'll look at all the big volume ones. Apple. And what do we have? A 2-day resting period. So we have this big wide range green bar on the daily, right? This is a 60, but imagine on a daily, it's a wide range green bar, and it's taking out, or almost taking out, 460. Then you have 2 resting days, 2 narrow range resting days. And then the next day, boom, there is your gap up. right? There is your gap right there. Boom, boom, boom. That little tiny dot. This is in the pre-market, by the way. This is pre-market. This is before the market opens. I'm looking at that dot and I'm going, juicy, juicy. What's the job? Put it on your gap list. Put it on your thumbnail watch list. Wait for a lower time frame entry. 1 minute, 2 minute, 5 minute, 15 minute, whatever. But I know this stock is likely going to go higher. It's in an uptrend. It's in an uptrend on the 60. It had 2 resting days, and now it's gapping up. Shocking. Oh my gosh. NVIDIA ripped that day. I just can't. Oh my God. Just dumb luck. Just stupid dumb luck. There's the pre-market chart at 475. Do you know how good that is? That's ridiculous how good that is. There's your daily clean, clear uptrend. NVIDIA went from 475 to 490 is $20 move. $20 move. It's nuts. Maybe it wasn't quite, yes, 490, yeah, it was. And then this is the post-market. All because of the higher time frame. Not rocket science. I didn't reinvent the wheel here. I just went down my dollar gainers and dollar losers list, and I found the stock that looked like it had the best higher time frame trend and the best gap. And then after that, I drilled down to the pre-market and saw this amazing, unbelievably nice pre-market consolidation. And it ripped. It's just luck. Just a blind squirrel chasing a nut. Another example. Here's a stock in a wedge, right? A little ascending triangle, higher lows, higher lows, higher lows. This stock gapped up and got crushed. Went from like 168 to 143 or something, $25 pullback. Moves up, it needs to break this red line. That red line is resistance at 155. All right, now, did we cheat a little here? Yeah, because it was like 154.50. Okay? Boom. What do you see again? I know it's getting old. It's like a broken freaking record. What do you see? Bottoming tail, bottoming tail. Bottoming tail, bottoming tail. After the higher time frame. This is a 60-minute chart here on the right. It's a 60-minute chart. Okay? Over here looks to be a 1-minute chart. Okay? Take a look at it. It's breaking out of this range, and it has void to 168. And the stock, at least in the first hour of the day, went up to like 156.50. $2.50. Get a 60-cent stop loss. Add on the 3-bar play right there. Pulls back and rips. Right? Stick to the fundamentals of technicals. Stick to the technical fundamentals. Okay? Another example. Nike. Higher time frame void, relative strength, lower time frame pattern. So note, this is a downtrend on the 60. Lower high, lower low, lower high, lower low, lower high, equal low. It's our first idea that maybe the bottom has been set. Maybe. But way too aggressive to go long. Way too aggressive to go long. It bounces back up. Good. But still just above the trend line. Then the next day it gaps up, and there is what we're looking for. Because now it has a double bottom retest with 1 higher high and 2 higher highs. Okay? So we are in that transition between a 1 and a 2. We're not quite in a stage 2. We're in a stage 1 transition into a stage 2 right out of professional trading strategies. Okay? Higher high 1, higher high 2. Now we need a couple higher lows. Okay? Then 130 to 132 plus is our void. We actually have void all the way up here, but just right there, we got $2. Okay? Now, what do we get? The market tanks. 2 minutes by 1, 2, 3, 4, 5, 6, 7, 8 bars down, 9 bars down. Okay, so the first 1, 2, 3 bars of the day go up. 1, 2, 3, Nike goes up. The next Oh my gosh, look at the market, look at Nike. Look at the market, look at Nike. Now, I probably should do this. Let's do it for a second. Let's just do it for a second, right there. Okay? Just move this over wherever it was, right? Boom. Just leave it there. I don't know what you see, but I see relative strength. And oh my gosh, what is that? A bottoming tail again? This is just a highly coincidental. There's so many bottoming tails on these charts. Market's getting hammered. Stock is not. Stock is holding near the high of the day. And it puts in a bottoming tail. The sellers tried to shake out the low of the day and push the stock lower with the market. And the buyer said, I don't think so. Nope, not today. Wide range bar comes in. You get a little 4-bar play. You're in at 130. You could have been in at 130, right? You could have been in at 130. But in this case, we waited for 130.25, put the stop at 129.75, and bam. $3 later, 6-1, starts on the higher time frame. Starts on the higher time frame. Another example, Johnson & Johnson. Gaps over a red bar and over a topping tail. Not a ton of room, but a good, $3 worth of room, something like that. Gaps over a red bar, gaps over a topping tail. What do we have? First bar of the day is red. Second bar is green, red, green, green, holding this 182 area nicely. What's the market doing? Same. Market's moving up. So you're buying a stock with the trend. You have relative strength with the gap and the market's moving up. Good. Get in at 182, give it a little bit of room, 181, maybe a little more room because it's a 1-minute chart. Rip to 186. $4 move. Higher time frame, lower time. Guys, if you're noticing something, because I've been quiet about it, what indicators are you seeing on my charts? In 1 minute, daily, 60. Let's go back and take a look. What indicators are we seeing here? Well, let's do it again. What indicators are we seeing here? Let's do it again. Getting bored. What indicators are we seeing here? Let's do it again. What indicators are we seeing here? Why do you need them? You don't. You just don't. Okay? Now, having said all that, you're like, what? You just said, screw the indicators. I did. I just did. But one indicator that I do put some weight into is the 200 period moving average on the 60 and the daily. Okay? Is the 200 period moving average on the 60 and the daily. All right? And if you take a look, Yaroslav, you need to do what you think is best for your trading. You can send me your results tomorrow if you want to. All right? You need to do what you think is best for your trading. Okay? All right. So, 200 period moving average, 1264. Stock chilling out just under, note, just under, it's important, under the 200 period moving average. Okay? Pivots, 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 pivots. Okay? And then, where am I at? There I am. Okay? Oh, what happened there? Gapped just into the pivot resistance and the 200 MA, right? No, it gapped up. This is a gap up. I know a lot of new people like, it's red. No, it's an up gap. This thing gapped up into resistance and right near or at, remember they're not exact pennies, okay? Right near or at 1263. This is very difficult. This is very difficult to go long on because the 200 period moving average is one of those few moving averages that is used across the board, right? It's used by hedge funds, it's used by money managers, dare I say market makers, and it's also a very long moving average. It's 200 periods, not 9, not 20, not 50. Gap up into this and it got smacked. You have to respect the 200 on the higher time frames, daily, 60, weekly, etc. Okay? Otherwise, I'm not a huge fan of indicators. I don't really use them at all. At all. Okay? Occasionally I'll look at the 50 on the daily, but again, great 2-minute buy setup. Watch out for the 200 MA. Okay? Well, you have a gap up gap up, okay, over this area, taking out this red bar, and this topping tail right there. And what do you get? It gaps up, pulls back, bounces, pulls back, bounces, pulls back. And you do get a nice trend. But when you get up into this area, you have to start being very, very careful. Okay? Very careful. Because now, not only do you have a full ATR, you have a full ATR into a daily 200 period moving average. Now, to be clear, it doesn't mean that stocks never break through their 200 MA. That's not what I'm trying to say. What I'm simply saying is be very careful as you approach these areas. If the stock smacks its head and pulls back, don't be shocked. Don't be surprised. Hey, you might get lucky and it might rip right through it. That happens too. But the 200 is one you need to be careful for. For example, if you have a target that needs to get through the 200 MA to hit target, I'd be very conscientious, cautious of taking that trade. An example of maybe an acceptable one would be, say you're doing a half at 1R and half at 2R, and maybe your first target is under the 200 MA and your second target's above the 200 MA. I'm okay with that because at least you hit one target, you're protected. Then you can see how the back half does. But if you're doing all or nothing and it's well above the 200, ooh, that's tough. It's tough. What is this? Trade the best of the best, guys. This is a gap from yesterday. Wide range, okay? Wide range, green bar, 2 green bars actually, and a bottoming tail, and a pivot. You could argue multiple pivots, right? There's a bottoming tail pivot and there's a pivot here. You could argue this is a level 1 gap. The only area that might be questionable is maybe it gapped a little more than it needed to. And this stock got crushed yesterday. Now, we talked about this yesterday. There were not a lot of great entries on this. But, hold on, and I'm not saying you should do this every time. The textbook, Professional Trading Strategies, allows you to take a 1-minute low on a genuine level 1 gap. It's in the book. It allows you to take a 1 or a 2-minute low, and it says in there, it's aggressive. But because of the high quality of the gap, it allows you to be that aggressive. So if you wanted to, you could have done that. But note, there is a small topping tail here. You may have gotten shaken out had you done that. If you've taken a 1 or 2-minute low, you may have gotten shaken out and then it dropped lower. But this is a very nice gap. These are the types of gaps you only see a few times a month, 3 to 5 times a month. We have to find a way to get on them. Yesterday, I did not find a way to get on this. It was on our gap list. It was on our favorites list, I think. But we have to find ways to get on these. Now, note the bottoming tail again. I don't have the higher time frame on this, okay? Just missed target on this, had to leave, blah, blah, blah. But note the bottoming tail. Are you guys understanding how big of a deal, how important these shakeout bottoming tails are? This is the computer sucking people in and pushing it right back up. And trust me, you don't want to get in front of the computer. You want to be those little remora fish or the little fish that jumps on the back of the shark or the whale or whatever. You don't want to actually be in front of it. You don't want to be the shrimp in front of the whale's mouth. You want to be letting them lead the way, letting them cut out all the crap, and then you jump on. So when you see that bottoming tail, jump on board. Okay? It's a very important concept. If you see a genuine shakeout on volume, wait for it to close. I mean, don't get me wrong. There are a few scenarios. I'm not going to get into them today, but there are a few scenarios you could actually buy the bottoming tail. But most of the time, it's better to wait for it to finish, okay, and then keep an eye on it. All right? I think this is incorrect. I think this is like 80. Is it really 86? Maybe it is 86. Yeah, maybe it is 86. All right? Anyway, thing moved up and, made $6,000 on it. Now, note, this is from today. We need to talk about this. This is exactly the type of bottoming tail I was literally just talking about. Okay? And I'm not going to lie, I bought Tesla at 183.50 before I even called it for the room. I did. I bought some at 183, like 45 or whatever the heck it was. And then pulled back Then this happened, this red bar right here. See this big red bar right there? I got very nervous when it broke this area. Like, oh shit, we're in trouble. But we gave this a lot of room, right? We gave this a lot of room. Okay? See it right there? We were we were under all this. And then what happened? It came all the way back to the high. I said, good. It's doing what it's supposed to be doing. Because it's extremely rare for a stock to set a $3 bottoming tail like this. It's more like a $2 bottoming tail, $3 bar, and then break the low. But Tesla is an unusual stock recently. It doesn't trade like Tesla used to trade. It's gotten a lot wilder and weird. I can't blame this on the market. The market didn't tank. The market went a little bit lower, but this is all Tesla right here. Again, the market did go lower, okay? It was also tough. Yeah, it was. It really was. But when you see a bottoming tail like this, you normally expect a small little bit of, chop, and then rip. And this was a significant bottoming tail. And then it did this green. And I thought, okay, maybe, just maybe, we have a chance if it breaks 182. Nope. Just tanked. And you know what? I'll take that one every day of the week, guys. If I see Tesla do the same thing tomorrow, I'll probably take it tomorrow. I like bottoming tails that much, especially when they're this big on that kind of volume and they push back up here. Could we have waited for the high of the day? Maybe, but hindsight's 20/20. So this is an unusual circumstance where a genuine bottoming tail got engulfed. Now, this is an unbelievably good trade. Guys, this is an unbelievably good trade. Okay? These are the type of trades that I look, hope, and salivate for. All right? We have a gap down in the Qs and then nothing for what? 20 minutes? I mean, it literally went dead sideways till about 9:55. Sideways. Microsoft gapped up slightly, pulled back, and ripped. It ripped. Left a bottoming tail and a topping tail. Note, 1, 2, 3, 4, 5, 6 days in, or 6 bars in, the Qs were going sideways. 1, 2, 3, 4, 5, 6 bars in, Microsoft was ripping. So sideways Qs, ripping in Microsoft. Microsoft's typically a highly related market stock. So when it pulls back 50% and leaves a doji bottoming tail, another doji bottoming tail, I looked at it and said, oh shit, we need to get us some of this. We need to get some of this. I got in at 392.15. And what did I do with my stop? Yaroslav. What did I do with my stop? I put it at 390.30. I could have easily used 391.30, but I gave it an extra $1. Right? An extra $1. All right? Chopped. Probably stopped some of those really tight people out right here. What did I do during this time? I added to my position. I added to my position at 391.40, 391.50. Okay? And after the add, I raised my stop up to 391. And then when it broke here, right here, I raised it to 391.30 under the bottoming tail. So I'm going to say it again. I got in initially 392.15, 392.20. Okay? Chopped around. Now note, the market, by the way, guys, at this time is fading lower. Just slowly chopping lower. Take a look right there. Microsoft during this time is holding. It's holding this green line. That's very important. It's holding this green line. Then I see a bottoming tail. I add. Keep my stop 391. So I gained 70 cents on the stop, which is why I was able to add. Once we broke back above like 392.60, whatever this was, I raised it to 391.30. And then it started moving up. So for me, I got my cost average down below 392, right? Because I added. I got this down to like 391.85 or something like that. Oh, excuse me. And then this thing ripped. And I think ultimately, I think it went to like 395.50 or something like that. Okay? And ripped. And take a look. The market didn't need to move much, right? The market didn't need to move much for Microsoft to rip. Guys, I absolutely, positively love this trade. I love it. Because you have a market that gapped down, went sideways, and continued lower, and you have a stock that gapped up slightly, pulled back, and ripped. Okay? The daily chart on Microsoft did what yesterday, guys? Talk to me. I don't have it on here. What did the daily... I know exactly what it did. What did it do yesterday on Microsoft, guys? Tell me. Talk to me. What did the daily chart on Microsoft do yesterday? Massive wide range red bar. Nasty wide range red bar. Nasty. Guys, what generally happens when you have a wide range bar? What happens the next day? Typically, what happens the next day? I mean a nasty wide range. I'm not talking about a little bit of one. I mean a big one. There's one of two things that happens. They either have a narrow range day or they go in the opposite direction of the big bar. They almost never, sure, of course it happens, but very rare, 10 or 20%, 80 to 90% of the time, the next day, they do not break the low of the previous day. And if they do, that's a peekaboo low. It's a peekaboo low. Okay? The next day, they usually either put in a narrow range inside day or they go in the opposite direction of the previous day. And again, I want to be clear here for the people that aren't listening. I'm not talking about your run-of-the-mill down day. I'm talking about a nasty, huge wide-range bar. Could be a wide-range green bar, could be a wide-range red bar, but a big-ass bar. The next day, they very rarely break below the previous day's low. They stay in a range or go in the opposite direction. Well, Microsoft did exactly that. And the market wasn't giving it much help. But Microsoft staying in this 50% pullback range, give or take, proved relative strength to me. Then it put in a bottoming tail and another bottoming tail. And I'm like, man, the market's not doing anything here. In fact, the market doesn't look very good. Microsoft's going to bounce. I'd be shocked if Microsoft didn't see 394. Sure as shit it did. I love this trade. I would like to see this trade every single day. Now, obviously, I would prefer it to trigger and just rip. I don't want to see it chop, 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 put me through the emotional roller coaster. But that's also because the market went against us, right? The market went against us. Had the market just stayed sideways or even went higher, Microsoft rips. And we know this because it's exactly what happened when the market popped. Every other stock is moving lower with the market. And the market just literally moves up, what, 80 cents? And Microsoft moves up $4, $3. Okay? This was a great trade. Did I hold for my full target? No, I didn't. I should have made $5,000 on this. I told you, I explained the whole Tesla situation, blah, 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 blah. Okay? So, indicators are subjective and usually a crutch. Price and volume are objective, and they are everything. Price, by definition, leads any indicator. I'm not against them. I just don't use many of them. And you saw it from the Tesla trade. You saw it from the Microsoft trade. There's not an indicator on this chart. There's not an indicator on my Q's chart. Because they're just not necessary. If you want to be a great trader, you will focus on this. You'll focus on this slide. Hence it says what is really important. And the really is in yellow and it's italicized. Because this is actually what's really important. Guys, listen to me for a second. I know it's arrogant. But I'm telling you, man, 20 years into this, having seen a lot of other places, there are some good educators out there in this business. There are. There are some real dog shit educators, 80% of them, but 10 or 20%, there's some real good shit out there. Really, I'm being honest and truthful. But you know what they don't do? You know what they don't do? One more time, say it loud and bright. You know what they don't do? Give you paid for lectures for free. None of them do that. This shit's right out of the damn textbook. Nobody does this. What they do is, okay, this is what they do. They take one chart like Tesla, maybe two, I'll go back to it, and then they spend an hour just talking about one chart. And they'll go, you're welcome for the wonderful, amazing lecture, and then they'll spend 20 minutes trying to pitch you on something to buy. It's the truth. Go listen to them. Go to another chat room. They just sit there and they just pitch you on shit. This is like the real stuff, right out of the book, right out of the course, right out of the horse's mouth. I'm here because I want to help you guys get better. And again, I know it comes off arrogant at times, but this is really what's actually genuinely important. And maybe I'm the dumb one, right? Because those people probably have chat rooms that are way bigger and their sales are probably way better. I just don't care. If you really want to learn, you'll pay attention to this stuff because it's the real stuff. I don't leave anything out. I don't sit there and go, well, I'm just going to save that for this. No. I'm showing you real trades that we took today on Tesla and Microsoft, real trades I took in the past, and then showing you pages out of the textbook where they match what we took. I hope you find it helpful because they won't be here forever. It's not a threat. I'm just telling you the truth. My rope is very short. It's very short. Okay? They're not going to be here forever. And then you'll be stuck with all those other places where the problem for those people that are new is they'll go to those places first and they're like, oh, I'm learning so much. No, you didn't learn anything. You just think you did because you don't know anything. You don't know what's bullshit versus really good information. When you do, you realize and you look and you're like, wow, this is amazing that they get away with this stuff. It's amazing. But enough of that. I hope that you guys learned a little bit more about how to be a successful trader and that indicators really aren't that helpful. You can still use one or two or maybe even three, but I would suggest you try not to use them. If you do use them, VWAP is very helpful. Moving averages are helpful, but really candlestick charts, those red and green things, are the most important thing as well as the volume. So again, I hope this lecture will help make you guys better traders. I'm Jared Wesley of Live Traders. We'll get back at it again next week.